Hey, and welcome back to the channel. As you may have noticed, Harvest has been very busy lately with many new releases, and have been very quickly expanding their high income shares product line. This year alone, by my count, they released at least 33 new ETFs already. One of the major changes that was just announced is to their most popular all-in-one ETF, HHIS. So here in this video, we'll go over some of the latest new releases, and how it influences some of the changes that have just been announced for HHIS and its strategy going forward. If you'd like to continue following from our content, feel free to like the video and subscribe to help support the channel. The goal is to hit 3,000 subscribers by the end of the year, and we have just over 2 months left to go. Thanks to those who have already subscribed, and now let's get into the video. So to start, the first thing we'll go over is the release of 4 new high income shares ETFs that are all now trading on the TSX. Originally, this was supposed to be 5 new ETFs, but there have been some delays to the 5th one, which will be based on JP Morgan. Eventually, it will be released once it is approved, and that should happen very soon or even by the time you watch this video. In terms of distributions and yield at inception, these 4 ETFs started trading at the price of $12. And based on that, Circle will be a 40-cent distribution, which will be a 40% yield. Reddit will be a 35-cent distribution, which will be a 35% yield. Robinhood will be a 30-cent distribution, which will be a 30% yield. And then SoFi will be a 32-cent distribution, which will be a 32% yield. The ex-dividend date for these will be October 31st, and the pay date will be November 6th. With these new releases, it brings us to the question of how we'll Harvest add these to HHIS. And that is what we're going to talk about next. But just quickly, before we get to it, there's also another release that was announced recently as well, and that is a USD version of HHIS, which is hhis.to. This is a release I was waiting for myself, and also might be of interest to those of you who have USD and are looking for an ETF like HHIS to invest in. A lot of the ETFs in the US tend to focus a lot more on the yield and sacrifice a lot of the upside or total returns. This is not the case for most Canadian ETF providers that try to find a balance between the both of them. And as well, many of the Canadian ones provide a modest 25% leverage that many US providers don't currently use. So hhis.u is probably one I'll be investing into, and I'm glad they finally have it available as an option. For some of the quick details at launch, the ETF is starting at a price of $13, with its first distribution at 24 cents. This would give it an approximate 22.15% yield at inception, which is about the same as the Canadian version. Otherwise, all the other details will be exactly the same as HHIS. At its launch, the objective of HHIS was to provide a collection of the highest yielding high income shares products in one single basket. And to do so, Harvest had a self-imposed cap of 15 holdings, so I would remain focused on that objective. But now, with the many new releases, they surpassed the cap number of 15, and we're at the crossroads on what to do next. There were 2 options, either to replace the lower yielding ones, or to increase the cap on HHIS to include more holdings. Of course, both options had their respective investors and preferences for what they wanted Harvest to do moving forward. So here, I just wanted to list out what I think are some of the pros and cons for each side, just as some food for thought. Because in the recent press release, Harvest announced that they will remove the cap of 15 holdings, and will be including all the 4 new ETFs I mentioned previously to the basket of stocks. So to start, I'll go over the pros and cons for the approach if they were to replace lower yielding holdings, and to keep HHIS as high yield as possible. For pros, by removing the lower yielding holdings, it can help to increase the yield much more significantly. With having higher volatility stocks, it comes with a higher growth potential of the underlying holdings. If they continue to replace holdings, they would likely be able to regain the title of highest yielding Canadian covered call ETF that holds a basket of stocks. Currently, this title is now given to Biggie from Evolve ETFs, which launched just last month. Then for cons, with more yield also means more erosion or price decline if the underlying holdings don't outgrow the distributions. And also, there could be more variability in the distribution amounts when the volatility starts to drop. Of course, for highly volatile stocks, the opposite is also true, where there's potential for stronger declines in the underlying holdings. By chasing the highest yield, some existing holders of the ETF may not be accustomed to or comfortable with experiencing more volatility after the relative stability we've experienced in recent months. This might alienate some of the holders by drastically changing what is already working for them to achieve $1 billion in AUM in just 9 months. So in summary, with aiming for the highest yield, it would likely mean replacing some of the Mag 7 positions in favor for some of these more volatile new single stock ETFs. This is because they are large established companies, so the volatility and premiums you can get on them are not as high as some of the smaller, more volatile stocks. Many of those who hold HHIS may likely have it to fulfill or cover the Magnificent 7 portion of their portfolio, and would prefer to keep all the holdings intact. Personally, I think if they wanted to chase the highest yielding product, I'd prefer they created an entirely new ETF instead. This way, it doesn't compromise those who like and are accustomed to what is currently working already with HHIS. Okay, next I'll go over the pros and cons of what they will actually be implementing going forward with HHIS, and that is expanding the number of holdings. For the pros, we get added diversification by keeping what is working and only making additions to it over time. And because of the increased number of holdings, the higher yielding or more volatile ones are smaller allocations, and therefore don't affect the overall behavior and movements of HHIS as much when compared to just replacing existing holdings. Then with the diversification, there's also the benefit of having the distributions being even more stable than they currently are. Because significant drops in volatility would have less of an impact, or can likely be offset by another holding. Then for the cons, the yield won't be as high, and over time there may be too many holdings, and potentially become over-diversified. And as the number of holdings grow, there might be a need to make another future change, from equal weight to a different approach. Because, just like how the indexes are market cap weighted, they may also want to consider something similar, in order to appropriately balance the yield and total returns. Also, because of the diversification, the overall yield will eventually find an average, and will unlikely see increases over time as more ETFs are added to it. So to summarize, with this approach, it essentially takes what is already working great, and is just adding to it over time to create more diversification and stability in the ETF. It's not going to be the highest yielding, which is a bit odd to say because it's already very high, but the chances of the distribution changing will be lower as more holdings are added. And as such, it continues to build upon Harvest's reputation for stability and reliability. There's also another method that this could go, and I sort of touched upon it in some of the pros and cons, and that could be a hybrid approach. This would combine the best of both worlds and lie somewhere in the middle. In this strategy, Harvest can continue to introduce new single stock ETFs and include them over time to HHIS. But in order to not sacrifice some of the higher yield potential, a weighted allocation model can be implemented to balance the yield, volatility, and long-term growth potential in HHIS, instead of an equal weighted model it currently uses. So that would mean having a slightly higher allocation to the more volatile and higher yielding holdings, but not to a degree where it sacrifices stability and longer-term growth potential of the ETF. We're currently not at that point in time yet where this is needed, but if they continue to release more high income shares ETFs, we may again come to a crossroads where further changes or even products might be needed to be considered, in order to satisfy the ever-growing competitive landscape for covered call ETFs in Canada. The last few years, and this year specifically, has been an exciting time to be an investor in the covered call ETF space. So far this year, in the Canadian covered call ETF directory I've built, I count at least 83 new covered call ETFs that have been released at the time recording this video. I'm sure we can expect more to come in the remainder of this year, and for it to continue into 2026 and beyond. Next, let's talk about the distribution and how these new additions might affect it. So this isn't going to be exactly how distributions are decided, because there are various moving parts that go into arriving at the final distribution amounts. Overall, this depends mostly on the options writing decisions by the fund managers, and the implied volatility at the time. But here, I'll do some simple calculations to see if we can guess what it might be once the new ETFs are added to the holdings. Starting with the current number of holdings, which is 15, if all of them are equal weighted, it would be approximately 6.67% for each position. Then we can add the current distribution amounts for each holding next to them. By doing the simple math of multiplying the weight and the distribution, we get the weighted contribution of each ETF to the current total monthly payout. Then by adding these values all together, it gives us an estimated overall distribution for HHIS based on the current holdings, and that value is 0.25633. This isn't going to be exact, but you can see it gives us a value that is very close to the current actual distribution of 25 cents. Now, if we do the same thing, but this time with the additional 4 holdings, we can see that because there are 19 holdings, the weight of each one will be approximately 5.26%. Listing the current distribution amounts like before, and multiplying the values, we get the weighted contribution of each ETF. If we add these values up together, now we'll get the value of 0.27447. Again, this isn't going to be exact, but we can see the distribution will come to approximately 27 cents, which is higher than the current distribution of 25 cents. This would mean we can expect a potential raise when the changes are made. It can be anywhere between 25 cents and 27 cents based on the calculations we've just done. With the current price of $13.59, we can also see what that would be in terms of yield. So for the current 25-cent distribution, it is a current yield of approximately 22.08%. If the distribution amount gets raised to 27 cents, then the yield would increase to approximately 24.24%. So you can see that would bring us quite close to the initial yield of HHIS at inception, which was at 25%. Just for fun, even if we were to replace the lowest yielding bottom 4 ETFs in Alphabet, AMD, Apple, and Costco, the yield still falls short of Biggie, which launched with a 30% yield. So to match Biggie, you would still need to replace a few more lower yielding holdings in order to catch up. Or an easier way might be for them to increase the leverage from the current 25% to 33%, though that amount of leverage isn't something that Harvest has used in the past, so it might be unlikely to happen. Again, this is just speculation, and Harvest can distribute whatever amount they would like to, but this gives us an idea of what to expect heading into the strategy change. The value would also change slightly as well once they release and include the JP Morgan ETF, so that's just something else to keep in mind. So what do you think? Do you approve of the strategy change, where they will continue to add new ETFs to HHIS? Or would you have preferred that they simply swapped out the lower yielding ones with higher yielders to increase and maximize the yield? Let me know your thoughts in the comment section below. If you like this video and want to follow for more, don't forget to subscribe to help out the channel. Thanks for watching, and I'll see you in the next video.